The government is examining the possibility of increasing the tax-free slab to 5 lakh rupees under the alternative personal income tax regime in a bid to make it attractive. You may have to pay lower taxes if the threshold is increased, thereby leaving you more disposable income to spend and invest. The alternative personal income tax slabs with lower rates were introduced as an option in the Union Budget 2020-21. At present, only a fraction of taxpayers have opted for the alternative tax regime. At present, income up to 2.5 lakh rupees is exempt from taxation under both the old and new tax regimes. Income between 2.5 lakh to 5 lakh rupees is taxed at the rate of 5% under both the regimes. An individual with a net taxable income of up to 5 lakh rupees is allowed to avail of a tax rebate of up to 12,500 rupees under Section 87A in both the old as well as the new tax system. So effectively, the tax liability of individuals with income up to 5 lakh rupees is zero under both the tax regimes. However, for many taxpayers, the outgo in the older personal income tax regime is lower if they make use of deductions under Section 80C and Section 80D. Government sources have told Business Standard that the issue has been taken up in the budget exercise. However, any proposal to tweak the new regime would depend on its impact on the government's revenues. There could also be a discussion on whether both the old and new personal income tax regimes need to be tweaked. So, how would such a move impact you and other taxpayers?
If the rate itself is changed, not only will it benefit those that have income up to 500,000 or 5 lakhs, it would also benefit those earning higher, because the first slab itself will be subject to zero tax. So there would be zero tax impact on 2 lakh 50 to 5 lakhs, and hence that would have a triple effect on those earning income beyond that as well.
There is a ask to increase the tax-free slab to 5 lakhs as part of the alternative personal tax income tax regime. This essentially implies that currently the 5% tax between 2.5 lakh and 5 lakh income per year, which works out to be about 12,500 tax. By making the tax-free regime up to 5 lakhs, essentially we're putting 12,500 rupees in the citizen's hand. I feel the savings will translate into higher investments. And overall, I believe that it's a simplification and a rationalization of the tax regime, which is good.
According to experts, the new regime has benefited non-residents more, since they do not claim significant exemptions and deductions. But a salaried person will be at a disadvantage if he opts for the new regime, since no deduction is allowed for items such as leave travel allowance, house rent allowance, standard deduction, Section 80C and Section 80D. As such, between the new and old regimes, which one would be a better option and for whom going ahead?
Those, for instance, that still have a significant amount of deductions and exemptions to claim, they would not possibly move over to the simplified tax regime.
Discussions have also been held about what the government could do regarding the capital gains tax regime in the upcoming budget. After the last union budget, outgoing Revenue Secretary Tarun Bajaj had said that the current capital gains tax regime needed a complete relook, with streamlining of the various rates and holding periods being necessary. The holding periods and rates of capital gains tax differ for different asset classes. As an example, equity and equity mutual funds attract short-term capital gains tax of 15% and long-term capital gains tax of 10% for gains above 1 lakh rupees. While short-term capital gains tax on most bond investments is at the tax slab the investor comes under, long-term capital gains tax is either 10 or 20% depending on whether it is a listed or unlisted bond or a debt mutual fund. For real estate, long-term capital gains tax stands at 20%. The Confederation of Indian Industry has recommended that the holding period for all capital asset investments, except immovable property, be reduced to 1 year. It has also asked for short-term capital gains tax at a blanket 15% and long-term capital gains tax at 10% for all market investment assets. However, there is some uncertainty on this front. For one, a reduction would go against the practice in other markets like the United States and the United Kingdom, which have increased capital gains tax over the past few years. Also, a government official recently told Business Standard that restructuring capital gains tax would be a separate exercise and might be done outside the budget, since it calls for extensive deliberations with all stakeholders. So, what, if anything, can be expected on this front? And what would be the impact of the industry's recommendations?
I feel that the rationalization of the capital tax regime is a great idea. Today, we have different timelines for equity holding. Long-term capital gains kicks in at 12 months. For debt mutual funds, it kicks in at 36 months. For property, it kicks in at 24 months. I think rationalizing both the time period and the quantum of long-term capital gains is a great idea to spur more investment on the retail side.
But not everybody thinks that any relief will be provided on the capital gains front.
Last 30 months, our markets have performed extremely well. Even the last 6-7 months, we have outperformed most of the global markets, which means most of the market participants and investors have made good money. In this sort of a scenario, I don't see the government offering more SOPs for investors. Equity market investors are paying STT. That's why the difference in treatment. And I don't believe this will be extended to other asset classes. They may provide clarification on grandfathering benefits, but again, don't expect any major changes.
India's top business leaders and industry bodies have asked Finance Minister Nirmala Sitharaman to rationalize income tax rates to increase consumption amid sticky inflation. A number of experts feel that it will also make sense to cut capital gains tax if the government wants to push its divestment program next year. However, others believe that while tax proceeds have been healthy this year, the fiscal deficit could still pose a challenge. Ultimately, it is this factor that will inform any decision by the Finance Ministry during the upcoming budget.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.